Welcome traders. Today I will be reviewing a stock, AT&T. I shouldn't really have to explain to you what AT does, but they're primarily in the communications market, and they've just merged with Time Warner, so they're casting a lot. They're pretty diversified right now. Like they got you got your cell phone service. Apparently they have internet. That's something I'm familiar with, but I've read about it. Now they're in the media with Time Warner. Time Warner has, HBO. They own CNN. Just media outlets. So AT&T recently has, starting to diversify in their business a little bit. Take that as you will. It's a pretty big corporation. As you can see, market cap's at 234 billion. See how much they're worth as of this. Oh, ooh, these are just announced. Good, that's perfect timing. I was waiting for the most recent quarter to come out here. I guess I'll look at their balance sheet. So they have thousands. So that's a billions, right? Yeah, it's about a $500 million corporation, and their market cap, it's about half of that. But we'll go back here. If you look at their liabilities, so that kind of paints a picture of why their market cap is the way it is and why their price is where it is right now. So I would say it's kind of valued pretty accurately. So their stock, there might be you might think they're a little bit overvalued because their stockholders' equities a little bit lower than, but I don't claim to be an expert on stock market. Right? I'm pretty good at rating financials, but how it correlates to the market, I'm still learning. So what I'm trying to do is present some technical analysis, bring some awareness to the stock, why you should buy it, why shouldn't you buy it, things like that. Start reviewing stocks on a weekly basis. Find things I find interesting or an possible opportunity. So I'm gonna try to sell you on a AT&T here. Um, so let's talk about the public opinion a little bit. I should note to myself to research this a little bit before I start my videos. See what other traders or what the public thinks. And what I've seen their criticism is of how much debt they have. That's a lot of debt, and it's not like but they have good assets, but it's not really equity. Like what is this, right? It's gonna be negative 129. So that's why it's bearish, right? And their liabilities might go up. I don't know if this is, well, when was the merger? Well, I don't even need to see because look, it's just well, I'm pretty sure it's because of the mergers. That's why their debt is going up. You could see it's just rising on all ends. And their assets are rising too. I don't know what the Time Warner portion is, but you can go back to the annual. Well, and you could see, well, their assets have increased, but their liabilities are increasing a lot faster. You know, 2015. Well, if you look at that, well, the major crash for them was. I'm not gonna go back there and look at that, but they've been recovering, but even though their net tangible assets, well, it's it's all right. It could be, but it could be better, and that's why we're not really that bearish, right? Well, that's why we've been a bearish trend recently. And it still hasn't ended, as you can see here. But, maybe I'm thinking that this is a reverse pivot into the bullish side. And I'll get to the technical analysis part next. I just want to talk about the business side, their financials. Um, let's talk about growth. Their earnings, you know, they've been they've been doing pretty well. Um, they beat expectations. They had a pretty good quarter. That's why I kind of bought more because I saw, I'm pretty happy with their growth, and I expect, once they fully merge with Time Warner, I don't know when that's gonna be. I guess, government's been involved and bureaucracy, all that other nonsense. We should pay attention to that though, definitely, because I don't know I don't know what's gonna happen if it does go through or if it doesn't go through. I'm not sure. I'm not sure what's gonna happen to Time Warner. I'm not gonna sure what's gonna happen to AT&T stock, but so overall, it's got pretty good growth potential. Um, I would be I'd be holding this for this stock is I think is a really good long-term hold. It's got pretty good outlook. Um, okay. So let's talk about their dividends. We'll get to the earnings in a minute. I'm trying to. It might be a little out of order, but that's fine. I'm trying to navigate my way through this. This is my first time actually analyzing a stock fully using Yahoo Finance. I like Yahoo Finance. It's free to use. It's easy. I think it's very user friendly. It gives you the data that you need, especially if you're like, a normal trader like I am. I'm not, I do this as a hobby, really. I'm just a hobbyist. So, um, so dividend growth has been pretty good. So right now, it pays 50 cents per stock. And as you can see, as I scroll down, it's been growing almost once a year. They add a penny. So the dividends have roughly 2% growth, well, as of right now. A couple years ago I would have said like probably 3%, but it's next year it's gonna be 51% dividends, and that's gonna be 2%. So the dividends have a 2% growth rate, which is pretty good. And if you buy it right now, that's a that's a 6% dividend yield, which I think is pretty solid. If you're looking at dividend stocks, that's why I'm trying to review this, because I think this is probably one of the best dividend stocks on the market. I'll look at more. Maybe my opinion will change. But I think this, out of all the dividend stocks that you could buy, I think this one has the highest potential for market gains and dividend gains at the same time. But you know, as I've read, having high dividends, it slows down, price growth. It slows down price growth. You have to be patient. These are considered lower risk than other speculations, especially if you're holding it long term. So I think this is a pretty good retirement stock. Um, because it pays dividends, it doesn't, what would the financials look like if they didn't pay out dividends every year? It's in the cash flow. How much money, how much assets are leaking out because oh, here it is. So, they paid $12 billion in dividends, right? Billions, right? Yep. They paid $12 billion in dividends, and that's increasing. Uh, I don't, and that's another concern, right? Like, why are they paying increasing amounts of dividends when they should probably take care of the liabilities before it gets out of hand. We've seen that with Toys R Us, that their liabilities got out of hand and it went bankrupt. You know, um, I don't see AT&T going bankrupt anytime soon. Um, but if it doesn't, you know, the merger coming up, and well, the merger going on right now, it's still in progress. If they're not careful, the liabilities could, just eat them alive, bury them, right? So, so that I don't really understand. But this just, reinforces the idea that this is just purely a dividend stock. You know, Instead of paying off their stockholders, I feel like the price action would be a lot better off. But this AT&T caters to holders, not speculators, not day traders. This is not a day trader stock. I mean, you could day trade a little bit, but it's not that. There's not much volatility compared to something else. But right, so if that 6% dividends yield entices you, and it's gonna get better going forward, then this is pretty good. Uh, like if you're not holding it already, what are you doing? The price is perfect right now, and I'm gonna try to show you why I'm using technical analysis. Let's clear the chart because there's a bunch of lines on here. These are my alarms, just ignore that. So just strip it bare. So let's take a look what's been going on since AT&T went public. Um, you know, Screaming when it first started out, it was a screaming bull. Uh, in 10 years, well, 15 years to be exact, it went up about 10 times. That's amazing. What a time to be an investor. Like that was great. Before 2000, being an investor was beautiful. And then we crashed. Why that happened is not that relevant at the moment, but it crashed about 70% relative to the all-time high, roughly 70%, not exactly. It broke through. That's why I like to use the 70, because during most crash, I mean, well, look, you sit. That's our A. We have an extreme A. There's the retracement. There's the B. And if you call that your C, well, look, it's right on the tick. Even if I tighten that up, initial public offer. Imagine that. Imagine still, people are still probably holding it and they're probably laughing all the way to the bank. They're set. But, you know, I want, like, what I would like is, like, 20 years from now, I would like to look back in this. I'm like, damn, I bought for $30. I was a genius, you know, buying for $20. Oof, that's pretty good too. You're sitting, you're collecting those dividends, you're happy. That that's the thing about dividend stocks. You could just the longer you hold it, the more happy you are with it. You don't really have to pay attention to what this action, as long as the dividends are consistent. You know, well, dividends are going 50 cents to 49 cents. Maybe you might think you might start looking at this like, well, what's going on here? But I think that could potentially be AT&T's undoing if they're not careful, because it's hurting their liquidity. And that's something they constantly have to deal with. Luckily, they're expanding their operations, they're increasing it, so I would expect their dividends to grow even more. I think that's why they merged, to increase the liquidity, increase the income. But you know, there's also cost of revenue too to consider. So they're banking on that Time Warner will, net them more profit and net me more dividends. Okay. So this is our. Well, should I put a wave on it? Well, yeah, well, let's leave that on so you can more clearly see that as I go along here. I'll probably move it later. So let's make that cycle. There we go. You know what, since it's nice and big, just take off the line. There we go. So there's our correction. And I believe it's over. So let's try to justify that. Take from the all-time high, go to the crash. It's between our hot box. I use Fibonacci numbers, 618 and the 50. Anywhere between there is a perfect buy. So that's our hop. That was our resistance. So that's where you'd be selling if you bought down. If you're looking to swing trade this, right? So, you bought during these lows, you double your money. That's not very great. 5 years, you know. So again, this just moves so slow. You're just looking, that's why, it's for the casual buyer. It's for, adding liquidity to a portfolio. You're just looking to set it and forget it. You're just looking to, reap those dividends and, allocate it maybe somewhere else. So, this is a pretty clean ABC. And that's why that just boosts my confidence that starting from here is a bull movement. Corrections move in threes. I can break this down, go down deeper. You know, well, it's a little janky, but let's take the major swings. Well, that's not. Well, look at that. Right to the 161, another Fibonacci number. Sometimes it goes a little farther. That's why I used the 175. But look at that. That's also clean. That's a clean cut. That's why I believe. That's why I believe that's an A. That's a clean cut A. Let's mark this down. Let's do a sub micro. Oh, let's leave it a micro. It's fine. Okay. Um. So let's not talk about the correction so much, and let's get back to the bullish nature. Let's make that argument that this is bullish. Um. Well, it'd be really bad if it went. Well, you don't really want any. Like, it depends how volatile it is, but you don't really want anything that breaks the 786. Strong market 618. But considering, when was the recession, right? So let's talk about what's going on. Well, let's put a count on this. Well, let's talk about what's going on right now, and I'll get back to the grand scheme of things. But that's definitely our one, and that's our two. So let's talk about this movement. Let's focus on the past 10 years. Pretty slow, of course. Um, what kind of count do we have here? Um, looking at it. Let's see. I had a count before, but let me see if I can remake it. Let's see. I see a swing here. Well, let's put markers on it. Let's see. So help me put a count on this. So we started here. Well, that's a potential one. So let's see if I can get a nice Elliott count. I use Elliott wave counts. I suggest read up about it a little bit, the rule of Elliott waves. But I'm more of a Fibonacci kind of guy. You know, well, I count 5 waves, but it's not. Before breaching the one, that's the only thing. I mean, it pierced it, right? It didn't stay there. So you could say, oh well, maybe there was some news that kind of pushed it down a little bit more than what the resistance was supposed to be. I'm not gonna, traders don't always have to stick to Elliott wave rule either. It's not that clean, but I could still. Let's talk about Fibonacci, right? Well, how's the fib stand out? It's very weak. The three, I could call that a three, a very weak three, not with much confidence, You could pull, this looks like a better contender for the three, but look how deep that four is. So we'll measure that in a minute, but where we're at right now. But relevant to that count, well, let's just mark it down. But relevant to this count, I care about, well, I feel like this is completed, so I'm going to pull from our C right here. It's choppy on the way up, but to here. And look where it is right now. We're right in our buy box. Mark that green because that's where we want it. That's where we want to buy. It's where you want to load up the boat. So if you're holding money, if you've been, watching AT&T for some time now, you're holding money. You're wondering when should I buy? When should I buy? The past year it's been going down. I don't know. I'm scared. Um, you know, I would suggest you buy right here. It just went to our 618, which is our Fibonacci number. I marked it gold because that's where we like it. So, the person that taught me trade Fibonacci numbers, the 618 is the golden number. We see it time and time again in the market. We see it very often. It's the perfect, you know, it's where you buy in your retracements. Right. So let's talk about what's going on in here. It's choppy. So, well, let's measure that out. Like, does that make sense? Well, yeah. Look at that. That's perfect. That's a perfect pivot. It's pivoted. We've yet to see if it's gonna go back down. That's why I've alarmed this. Just barely missed it by $1 almost. I wish I bought down there, but in the grand scheme of things, that's fine. You're not always gonna get that precision you like, but that's good enough to buy right here. That's where I've been buying. That's where I've been loading up the boat in this area. I've been buying AT&T for about $32. Yeah, that's 6%. That's perfect. Yeah. So I think that this is a 2. So let's zoom out and get an Elliott count for the grand scheme of things. Let's put this smaller, sub-minute. Yeah, there we go. So let's put that smaller. Let's clear this up because it's just noise. So now we can get a pretty good count on where we're at in the Elliott spectrum. So the first super cycle is done. I'll uptick it in a minute. So we're looking for our, the third wave is going to be the biggest. So that's what we're looking for. So this is our super cycle. That might not be an accurate term, but it's the largest cycle. Like what are you gonna call it? Super millennium? I don't even know what that is. But I consider the super cycle to be the largest cycle. As time progresses, well, that's gonna be far away. I'll probably be dead until the super cycle finishes. Who knows? Okay. So this is where I'm at. Well, let's talk super cycle numbers, right? AT&T might have another 50 years in it. It's only, you know, about 40 years old. Well, not 40. Hold on. About 34 years old, and still, since it got public, and it's, still going pretty strong from where it started. So, um, so let's see where our super cycle goal is. This is where we want to sell for, or start paying attention before a crash happens.
So I'm going to pull from our lowest low to our highest high to where our two ends. So I'm calling this our two wave. We got pretty deep A. So here's our targets. I would put an alarm on it, but the alarm would probably expire by the time it happens. So, $76, $91, and $110. Those are our three targets. So we have our target set. So I'm going to put our 3 up here, our 4 down here, our 5 up here. So, who knows how long our super cycle might complete. I can try to put a pitchfork on it and try to give you a time frame on it. See, so you start from here, pull to the highest high, drag it to your 6. Well, the modified shift continue, it's moving too slow. So I would say, considering the facts, this is a dividend stock. We know it moves slow. So, let's see if I can send this to the right. There we go. So, trading doesn't even go that far. It might break through. Since this is our 3, we expect it. So it might happen sooner. That's what we hope. It happens sooner than we think. We think it's going to break out, completely. Yeah, if you're extremely bullish, it's not getting off to a great start. But, this is our 1, 2 of the 3. I'll get to that in a minute. But, this is our extremely bullish scenario. Okay, so let's try this again. So right now it's really squished in. That's as far as I'm going to try to make it go. To 2049. That's about 30 years from now. So using this pitchfork, we'll already expect to double. We expect to double well, 5,000 dice from now. About 15 years. That's pretty bad. we expect about. Well, that's just a modified. Well, let's maintain our. Well, it should have doubled, 2 years ago, which it didn't. So if you're going to be unrealistically bullish, still, it takes a long time. That's 30 years from now. We expect it to triple. That's ridiculous. That's definitely not going to happen. So don't expect to get rich off of AT&T. Is basically what I'm saying. We're looking for revenue. We're looking for income. Well, we're just going off. So that's why this is a modified shift, because we're considering time and how slow this moves. Okay. So our super cycle is might not ever end in our lifespan. So okay. Well, what about this movement, right? So this is a 1, that's a 2. Almost 6, right? That's perfect. That's perfect for a Fibonacci Elliott wave count. So where's our 3 going to be? Well, assuming that pivot is in, that 2 is in. Let's fine tune this too. Helps a lot. So get some fine tune. So let's remove the old stuff. Let's clean up. So we can look about, from 2018 to now, to the next 10 years. So, our goal is $67. We're looking to double. How long is that going to take? Well, we expect our 3 to maybe be slow. Let's stick to original for now. You're going to be holding on to this for a while if you are looking to double your investment. Just on market value. We're not considering dividends. So, we're looking at 2033 maybe. That's the bullish stance. Even that, we have to break. You also have to consider we have to break this resistance. So maybe, maybe it might be more reasonable to expect it to be $66 in 30 years. So, buy this with the intention of just not selling, holding it forever until you die. Pass it on to your great grandkids. Buy AT&T for your kids. I think that's a great buy. I can also find stocks that move a lot quicker up, but that's not the point. That's not the point of AT&T. Trading AT&T, you're not trading, you're just buying and holding. So, pull from here to here. I mean, with the, well, hey, look at that. But with the Time Warner merger, who knows? This could transform into some, outrageous bullish movement. Could be, triple in a year if Time Warner, but, that's not so unpredictable, you just look at analyze Time Warner's numbers and just apply that to how that's going to help AT&T. There's some fear that the merger might not happen. There's fear that, the liabilities are getting too high. There's plenty of fear. So here is our, this was interesting. Here's our resistance. With polar A, that's even better. So, I'm a little, I'm not sure, whether to pull it from here or here. If I pull it from here, that's right to the tick. Look at that. Zoom in on that. It's almost right, that's right to the 6 minute. That's unbelievable. That's almost exact. Right to the tick. If I try to dial it in as close as I can. Get that right, get that tight. Get that right, get that tight. That's what I was saying. Went to it, didn't make it. Now we're here. So that, now it's not to the tick, but, that, failure to meet resistance, now we're there, right? So, there could be an alternate count that says, well, what is this? That's not here to where we're at right now, to that 1, this to this as a 1, speaks a little more. I mean, well, if that's the case, then we've, the risk is that, $28 rather than $30. Is that really going to break? I mean, just the average down. That would be my advice. My advice to myself, whether you want to follow this advice or not is up to you. I don't claim to know everything. I don't claim that this is exactly what's going to happen. It's a possibility that AT&T could, collapse under its own weight and go bankrupt. That's a possibility. That's kind of the fear right now. We see that, with Toys R Us. Well, Toys R Us was a special case because, well, not really, because, I have to know the specifics of the Time Warner merger, how that was acquired. Was that acquired fully on a line of credit? Because that's how Toys R Us was, acquired, and it wasn't growing as fast as they wanted. It couldn't outgrow the liability, and that's a risk that AT&T, kind of faces. But I don't see it to the point that it's crippling. But, that's a 75 to 1 asset liability ratio, almost. Almost. So that's just something you have to consider. Okay, what else is there to talk about? So as of right now, I'm making the case that this is the start of our impulse. We're coming down to a trace. Whether that's our pivot or I might, correct down a couple more cents. Let's just, buy right here, then buy down here, and, average down where it makes sense, too. Don't just, well, it went down $1, let me just buy more. No, well, was that technical? We want the dividends to grow, not the price. But, sometimes the price could be a signal that this company, stockholders see what's going on, they don't like it, they see the company going downhill, they're shorting the hell out of it. So, make of that information of what you will. Make your own determination of whether you want to buy AT&T or not. I think it'll keep growing, and you'll be grandfathered, you'll be locked in at that 6%, and that 6% is only going to go up. You'll be locked into that 6% dividend yield. And, you can retire on that. You also want to diversify, too, of course. But, when you reach that retirement age, you're going to look for dividends. And guess what? You're locked in at this dividend. It's going to treat you well. You don't have to, you got that at a discount, 40 years ago. Well, how you want to proceed going further from today is up to you. Do you want to move all of your, well, I wouldn't say, do you want to see majority of your portfolio? That's up to you, Do you want to just lock in now on the dividends? Because, I'm saying, I'm making the proposal that this is going to be going up over the years, You don't really want to average up, but that might make sense. If the Time Warner deal pans out and would break this resistance, that'd be great. So as soon as this, we don't know until it goes over $60, and that may take a whole long time. We'll never know. It'll take a long time if we know that buying right here is a good idea. And, there were no really, well, let's look at, well, I'm an idiot for not, but, well, let's look how technical this moves. Not really, there's a clear indication to buy here. There's really no clear indication, okay, well, that's really shallow, I put a buy order down here, it didn't take, and now it's off to the moon, well, I missed it, I guess I'll just wait for the retracement, okay, I'll buy it here, oh, it broke, do I sell, and you were buying at the 30, guess where we are right now, $32 zone, we keep coming back to it, huh? And it just so happens that that's, my average cost per share is $32. That's a coincidence that I got into it at $32, but, so you kind of see, we'll revisit it, little rejection, then we visit it, and then here we are again. We keep coming back. That's why it makes sense. It just makes sense to have $32 per share. AT&T has passed 8 years just kept revisiting this zone. Retroactively, I can't make that argument, but as of right now, it's okay, pivoted off of that. Some offered some resistance, but pierced it. Here we are again. So so right now we're looking to break through this. So that's why I alarmed this. Let's get around this, so you can clearly see what I'm looking at. Well, look at that. The 618 of the 5 to the C, 38.69. Maybe 37.05 might be. Is there a point of alarming if you really want to sell? You're not getting, if you sell your stock, you're not getting the dividends. You want to get yourself in a position so you never sell. Don't ever sell the stock if you're looking to get into it. Unless you get back to the dividends. It's kind of hard to technically analyze this when you have to consider that this is a dividend stock. But if you mix it in, you can kind of use the technical analysis to see when to buy, not when to sell when you're dealing with this kind of stock. You want to see dividend growth, and you want to see that, when you sell it, eventually it's not going to be a loss. That money will, you're going to get paid back in dividends anyways, but let's see, assume you don't put back in the dividends, but, you're guaranteed double in 16 years as long as it pays consistently. Even less if you reinvest those dividends. I'm not going to knock that out, because that'll take forever. Well, I guess I could. Some off-screen math right now, boys. If you're reinvesting it, I have the math on side here. That's roughly going to be 12 years. Assuming we reinvest at the end of every year. Quarterly, it might even be, well, let me math that out too. It's going to take, about, a little less than 12 years if you're reinvesting it every quarter. And that compounds upon itself. So, in 12 years, you're almost guaranteed to double. Not almost, because, dividends slow down. That's a possibility. That dividends, AT&T losing liquidity horribly and can't afford to pay dividends and has to reduce it. That's a risk we have to, assuming that risk doesn't exist, 12 years. 12 years you'll get back in revenue. And it keeps compounding. It keeps accumulating. That's kind of how your retirement works. That's the earlier you start. That's what I said. The earlier you start, and the harder you start, the better. So this is a little something to manage yourself. Get like a Robinhood account or something small. Start small. Or you could just, well, it depends what platform you want to use. I prefer Robinhood, no fees, or there's other platforms. But I just don't like paying broker fees for my trades. I just manage it myself. I don't pay anyone to do it. So it's like my own self. Because I have my own retirement. You call me an idiot, but I have my own retirement on the side. I'm not really going to be screwed here in the long run. If this doesn't pan out for me. The possibility that goes bankrupt. But you have to prepare for these things. That's why when you have to. That's why you have to use technical analysis. When should you jump ship, right? Well, you jump ship down to. That's pretty hefty risk. It's up to you where you want to decide to jump charter or to jump ship. It's going to pay most of it. That's a 36% risk using technical analysis. Can you take that risk? How much? How farther do you want to take it? Do you want it? Do you want on the other? The 65. That's it. Sometimes the 618 gets breached. It usually pivots off the 65. That's a common stop. So I don't want it past it. We want the 10%. Well, it's almost 10%. If you buy it today, it's about 10% risk. Not bad. When you gamble, your risk is losing everything, don't you? I can't even get that precise. God damn it. That's about 10%. Are you comfortable taking it down 8% as it might happen? That's a possibility because it didn't pivot off the 618. Are you comfortable taking it down to 7% or you hold it? You should, because this is a dividend stock. If you hold this for 2 years and you sell it back for $30, you sell it back for $30 and you break even, you're still getting hurt by inflation. You expect, but you're breaking even. A lot worse things can happen to you. Breaking even is always worse than losing money, but keeping that money in the bank is better than breaking even on the market. So, take with that as you will. So, at the end of the day, I would, park some in your portfolio in here, There's other dividend stocks to buy. That's the whole point of diversifying. I'll talk about that, maybe next weekend or next time we do a video, I might want to talk about, maybe a non-dividend stock. I kind of want to talk about this stock called JGX, but it's not looking good right now, so, I only want to talk about opportunities and not horrible bears, because JGX is bearish. I have to think about what stock, maybe Tesla. Tesla's hot. Everyone's talking about Tesla. Facebook. Facebook was amazing. You know what? Let's do Facebook next time. That's what I'm thinking. As far as I know, Facebook doesn't pay dividends, so it doesn't pay liquidity to its shareholders. So, potential gains short term, the risks are higher, but the payouts higher too. That's the idea. We want as little risk as possible, maximize our revenues here. So that's why we look into dividends. So we'll wrap that up. Feel free to leave comments, what you think. If I do an alternate account, I'm going to probably be here all night. I'll do that. I'll try to make this as short as I can, reasonable time frame. And that's how I wrap it up. So thank you for watching. If you've sat through my whole video, this is the second time I've been doing this. I did, a penny stock a while back. I'm done with penny stocks. You know what? Maybe in the middle of the week I'll talk about Helios and Matheson, the MoviePass stock. That's an interesting thing to look at, just to laugh and mock. So look forward to that if I decide to do it. All right, thank you for watching.